The housing market is stuck at the moment with only two real directions for which house prices can go. One is moving sideways and the other is home prices move up, ultimately becoming more expensive. And that's largely due to the manipulation of the Fed over the last couple of years. The Fed is essentially stuck between a rock and a hard place based on how they're looking at data. If you remember correctly, they were still pumping the economy with money while calling inflation transitory for the better part of 2 years, essentially paying way too much attention to lagging data. Now guess what? They're doing the exact same thing on the other side, paying way too much attention to lagging data. And they've primarily done that by paying way too much attention to employment. Ultimately, the Fed wants to raise unemployment. They want more people to lose their jobs because that helps slow the economy and in turn slows inflation. And because so many boomers decided to retire early, so many workers decided not to come back to the workforce during the pandemic, it's created a large gap in the workforce with nearly 10 million jobs available at the moment. And normally this would be seen as a bad thing, but instead the Fed is looking at this as an opportunity to potentially have wage inflation because these employers, in order to get employees to come to work, they're going to have to raise wages. And higher wages means more dispensable income, which in turn goes and gets spent in the economy and in theory pushing inflation higher. And that's why until a couple of days ago, there was a really high likelihood that the Fed might hike interest rates again at the June meeting, which ultimately could still happen if inflation numbers come in higher than expected the day before that meeting takes place. But here's the thing, we're starting to see some chinks in the armor. Some data out there that shows that the economy might be slowing a little bit more than they had anticipated, and in turn giving them an opportunity to stand back, watch what happens, instead of making another impulsive decision, in my opinion, to continue to hike rates. This past week, we saw jobless claims increase more than expected to their highest level since October of 2021, totaling 261,000 versus the estimate of 235,000. Now, if you remember, about a month ago, we were having a similar conversation where the numbers were reported really high. Well, just a couple of days after that, we found out that Massachusetts was somehow doing fraud on the numbers that they were provided, and in turn, those numbers were revised down in the future. So assuming that doesn't happen, this shows that more and more people out there are losing their jobs, and in turn, that should cause the economy to slow down, resulting in lower inflation. At the same time, we just got news that Canada's non-farm payroll equivalent, which is essentially how they measure employment, fell 17,300 jobs versus the previous reading of 41,400 jobs. Now, this is the first negative reading since the post-COVID labor market volatility stabilized, which essentially shows that Canada's economy is now slowing. Now, while that doesn't directly affect the United States, it does show that the world economy could be slowing down, resulting in lower inflation across the board. But here's the thing, there's really two things driving the housing market at the moment, which we're going to talk about in just a minute after you hit that like button if you find any value in my videos at all. And do me a favor, subscribe to the channel to stay updated on everything real estate related. Those two things that are driving the economy is inventory and interest rates. And as you can see from this chart here, inventory is sitting at 436,000 homes nationwide, which is nearly the lowest level that we've seen on record for this time of year when compared to more normal markets. And that's primarily because new listings aren't coming to the market. As you can see from this chart here, new listings are headed in the wrong direction. So how is inventory continuing to build if new listings aren't coming to the market? It's because homes that are on the market are sitting longer, and new homes, while they're not increasing at a rapid pace, are coming to the market, and in turn, that slower demand is allowing inventory to build. So why aren't new homes coming to the market? Well, Robert Revkin, who's the CEO of Compass Real Estate, said it absolutely perfectly, saying that sub 4% mortgages are essentially handcuffs for home inventory, meaning that the nearly 90% of Americans out there who have an interest rate below 5% aren't going to trade that rate in for a higher rate, essentially locking them into their home. And that's exactly why I started the video saying that home prices have two directions they can go. One is moving sideways, being more stable, and the other is moving up where home prices become more expensive. And let me take a minute here and clarify what I mean. When I say home prices move sideways and remain stable, that means they can go up a couple of percent, they can go down a couple of percent, but they aren't going to crash. Home prices aren't going anywhere anytime soon. And it's because of that lock-in effect that we just mentioned and the lack of available inventory on the market. In addition to that, you still have a third of the homes out there being purchased in cash, which is the highest level that we've seen in 9 years. And what I meant by the other direction, that home prices are likely to move higher and become less affordable from here, is that if interest rates come back down, which they are going to do, that's essentially going to push home prices back up. In fact, if you've ever heard of Barbara Corcoran from Corcoran Real Estate, who's made an absolute fortune owning real estate, said it really, really well, saying that it's a good time to buy because when mortgage rates drop, home prices are going to explode to the upside. And this will continue to affect the middle income borrowers the most because those are the demographic with the most severe housing shortage. At the moment, middle income buyers can only afford to buy around 23% of the available inventory out there in the market, where at the same time, those that are considered high income earners can purchase nearly 85% of the available inventory out there, which is exactly why that gap continues to grow. But here's the thing, mortgage applications are currently declining, mortgage rates are sitting near 7%, and even as we've seen mortgage rates retrace just a bit, it hasn't really revived home buyer demand, at least in most parts of the country. And that's due to that lack of inventory that we talked about a moment ago. There's just not enough property out there, properties that people want to buy out there in the market, on top of housing affordability being a big issue. But here's the thing, real estate is local, and that's why you're seeing housing supply plunge in some areas of the country while surging in other areas of the country. Now here in Southern California, where I'm located, we have a lack of inventory. In fact, a lot of the West Coast has a lack of inventory. In addition to a lot of the Northeast, I'm hearing also has a lack of inventory. Those markets that exploded the most over the last couple of years, markets like Boise and Austin, are seeing a big surge in inventory, but it's not really driving home prices down like many people out there had expected it to. But here's the thing, there's a couple of things happening in the economy at the moment that I think is going to lead to lower inflation along with lower interest rates. One, the US is skirting on the edge of recession, as companies like Target are starting to warn of sluggish sales, in addition to companies like Dollar General slashing their full year outlook. And that's because there's less consumer spending out there, which in turn leads to lower inflation. But here's the thing, even though the Federal Reserve may pause its interest rate hiking campaign, it's still likely to be felt by consumers because of the effects of higher rates. Just because the Fed pauses doesn't mean they're going to lower the Fed funds rate, which in turn means the payments that you're making on your credit cards, the payments that you're making on your student loans when you have to start repaying them here in the next couple of months, and the fact that prices aren't just going to drop because inflation comes down. Inflation is about price momentum, so inflation can come down while prices remain high, in turn leading to less spending out there in the economy. On top of that, I expect the spread between the 10-year and the 30-year fixed to start to normalize a bit as we start to see inflation numbers come down. As you can see from this chart here, the average spread between the 10-year treasury and the 30-year fixed rate for the past 50 years has been 1.72%, whereas the average between 2020 and 2023 set around 2.1%. And so far, the average for this year has been at 2.78%. But as of today, when I'm shooting this video, we're sitting around 3.1%. So if you're watching this going, Jeb, what are you even talking about? Well, typically what you can do is you can take the 10-year treasury, you can add that spread on top of it, and that in theory would more or less tell you where interest rates should be, which means if you use that average for the past 50 years at 1.72%, that means today we should have an interest rate sitting around 5.5% versus the 7% that we're sitting at today. Now here's the thing, I don't think any of us expect that spread to normalize back to 1.72%. In fact, if we just saw the average spread that we had between 2020 and 2023 at 2.1%, we'd have an interest rate today of somewhere around 5.9%. In fact, there's only been 3 times that we've seen spreads over 3%, and they were all during periods of high inflation. So here's the thing, assuming the trend continues and inflation continues to fall, so should that spread, which will lead to lower rates. Now with that said, housing is only one sector of the economy. It's all I know. I'm a one-trick pony, if you will. So I'm not really the person to be able to tell you how what's happening in the housing market is going to affect everything else, but I think housing is stable for the time being, and it's largely due to the lack of supply in the market. So until you see a lot of supply come to the market, which I don't see any world in which that can happen, you're not likely to see housing move down in any significant way. But with that said, there are some other things happening in the economy that I think are big issues. Now, I'm not a pessimist by nature at all, but I like to look at the big picture. I like to read the negative stuff, I like to read the positive stuff, and make my own interpretation of what that means. And one thing that I've talked about for the better part of a year and a half, and why I got interest rates wrong to start with, right? I said interest rates would never get this high. And that's largely due to the interest that our government is paying on their own debt. So as they raise interest rates, in turn, they have to pay higher interest on their own government debt. As you can see from this chart here, the blue line on the chart represents interest payments on the US debt. Now just take a minute and look at that chart over the last 3.5 years when the government was pumping money into the economy. In fact, within the next year or two, the government will be paying $1 trillion, $1 trillion on its interest payments alone. And within the next year, interest payments on debt will exceed the national defense budget, on top of likely surpassing Social Security in the next couple of years. Now, I'm not a genius by any means, but this is a problem, which is exactly why I don't think interest rates can stay high for very long. The simple answer is our US government simply can't afford it. So with all of that said, just make sure if you're planning on buying a house, just make sure you have a longer term time horizon for the things that I mentioned here. Over time, your home will be your largest source of generational wealth. But at the same time, you shouldn't be buying a home if it's not the right time in your life, or if you can't afford the payments, or if you plan on just owning it for a year or two. But here's the thing, in my opinion, the housing market crash is over. And if you're wondering why I think that, do me a favor and check out this video here.